So, if we have indeed reached the limits of a debt or credit based money, what comes next? Well, one of the things we can look at is ownership or equity. And one example might come from this. This is 50 Norwegian kroner. Now, there are very few examples of countries around the world developing pools of assets. But Norway has one. There is a fund, which is often referred to as simply the fund, which comes from the North Sea oil. They expect it will run out one day. And so some of the revenue from it is being put away, about $1 billion so far, which isn't much, but for a nation of 5 million people, it adds up. And it's being socked away and invested in various things. It's one of the few examples from a country. There's the Alberta Heritage Fund, the Alaska Permanent Fund, also funded by oil, but Norway is the only country that really is building value, building equity. And in many ways, equity is the opposite of debt. Now, what is equity? There are many definitions in common language, but what we really refer to is an ownership stake rather than a debt stake. Stocks are equity, whereas bonds are debt. Now, the difference may seem trivial, but the main feature is that when you have an ownership stake, you're not automatically owed something every single month. There is no fixed value to the underlying asset. It can grow and go down as well with the underlying value of the company. But it is reflective of the value of the company or whatever that particular piece of equity represents. Whereas a bond is supposedly a fixed value that goes up and down with what? Interest rates, an external thing, something not related to the underlying value of the company. And it requires a fixed payment every month, overhead. With something like a stock, they might pay a dividend in good times, but in bad times, maybe not so much. So, how do we build an equity model? I mean, if we presume that we have really outstripped the ability to have a debt based economy, simply because there is so much deflationary pressure, that is, prices will tend to come down and the value of money always goes up. And the deflationary pressure is only increased when you get to a certain amount of debt in the economy. And so, even though you're trying to print more money, you're really just have two opposing forces coming together. That is what I believe is really going on. And that's the situation. The time value of money has broken. Money today is not worth more than money tomorrow. And so the whole concept of interest fails. And we have things like the European Central Bank issuing negative interest rate bonds. Given that, how do we move from a debt based system to an equity based system? And what would that look like? What would that mean? We have a little bit of an example from Norway, but let's go a little bit further. See, the US federal US federal debt, which is well over $20 trillion now, bigger than the economy, is never going to be paid off. It was paid off once during Andrew Jackson's time, but that was a very different situation altogether. We're not going to pay this off. It is a permanent debt. So servicing it is a big feature of the government. And it becomes something like a welfare program for people who have put out their money for the debt. What if we change it to an equity model? Now, equity, again, is often an ownership kind of thing. We're not saying that we're going to sell the federal government to people, but what if we have an equity-based model where there is a dividend that goes up and down depending on the state of the economy? How would that look? First of all, what would you fund it from? A simple way would be to take all of the equity markets and have a small tax based on them. Now, the total volume of all stocks sold in the United States is about $70 trillion. It seems like a lot. But if you add in all of the options and the commodity futures especially, you get to an astonishing $400 trillion that's traded every year. Now, much of this is cycled up and down, back and forth. But a simple tax of 0.1% would raise a good $400 billion a year. Okay? Now, If this was dedicated directly to the equity of the United States as a dividend payment, then owning that equity would be essentially the same as what? Buying the market, or the dynamic, how dynamic the market is at any given time. And $400 billion dollars would give us roughly a 2% return on the $20 trillion dollars in debt. So it's a pretty good number. It's a good ballpark to start with for analysis. If a share in the US total equity was $100 for the sake of argument, what would happen? Well, for that $100, you would get $2 every year for as long as you held it. This would create a stable value. Remember, US bonds today go up and down in value based on the interest rate. If the interest rate goes down, the underlying value of the bonds go up. This is by design. They don't represent a stable place to park things. And if we see anything that is going on in the world is that a safe harbor, a place to put savings that is a good base to keep it and it preserves value, is highly desirable. And this would encourage savings by everybody if we have something that is open to the whole world. So we start with, say, $100 per share gives you $2 a year, or something that goes up and down based on how active the markets really are. How would this work? Well, the amount of the value of this would go up if there was more value in the markets. So the value of it goes up automatically as the economy becomes more dynamic. A more dynamic economy needs more money, right? So the money supply can increase automatically. Now, this would also provide a good baseline for banks to hold, and I'll get into the commercial part of it later. But these basic shares as a stable value, a place to park things that's going to hold its value, you'd want to keep it at the same level, and that would be the goal. Everybody would watch this like a hawk. So even though it's a little political, keeping it at 100 would be what everyone would want to do. When times go bad, investors would flock to the safe harbor, the net value would go up, the government would have more to spend. That gives you the ability to have a Keynesian stimulus, right? To bring that back down to 100 based on where investors are looking at. And it's market controlled. Now, these wouldn't be voting shares or anything like that. It would be simply shares in this debt against the revenue that comes what? From the trading in commodities and everything else. Now, 0.1% would affect the commodities market. It would probably come down a little bit. All arbitrage would have to be more than 0.1% to make a profit. But there are many signs that the futures market as it exists is over trading, that it is not contributing to the stability, and I'll talk about stability later, but is actually exacerbating ups and downs, which is not what it's supposed to do. So calming that down a little bit would help, and that's just one of the side features. So we now have a stable place to put money that can go up and down and expands in value and gives the government money to spend in bad times when investors flock towards it. Ideally, this would be done only for capital goods. Unfortunately, the United States government, unlike almost every other nation that I can think of, unlike every state, unlike every corporation, the way we do our accounting doesn't really follow the generally accepted accounting principles. We don't separate ordinary expenses from capital. It's another discussion altogether. But ideally, this would be just for capital, so that when we spend and have something that goes into this, takes out of this equity fund, that we're getting something for it. Roads or railroads or some other infrastructure, or at least fancy airplanes. But anyway, that's a side note. So now we have something that's beholden to the market that represents a store of value, a safe harbor for investors and ordinary people everywhere that can go up and down with the market and can help regulate the money supply itself. This takes us to banks. Now, fractional reserve banking is one of those weird things. This is where all money comes from, the generation of that debt. But if banks instead operated on an equity model, how would that work? Well, we actually know that because in the Muslim world, interest payments are against Islam. There is the Quran, Muhammad specifically said that you shouldn't do that. So Islamic banking takes out an equity stake in a corporation, and the payments go up and down. This may sound like it's not known to the Western world, but it's been a feature in London for a long time. The British government has found a way to regulate banking that is done on an investment equity basis. And we can look at Muslim banking as just an example of how that might work. But if you look at, say, a credit union model, where every dollar that's deposited in the credit union is essentially a share of that bank, now we have a complete equity model for lending that doesn't rely on things like fractional reserve. And it will also go up and down with the strength of the economy because the underlying value of the assets that have been invested are always there. A bank can sell off those assets to somebody else. You can have loan processors and equity processors and equity maintainers, just as we do now in the system. And then that money can be made available as it's sold off. But what's different about all of this system is rather than having the bond market, a few small number of people that are trading in US bonds determining how the money supply goes up and down, it's determined by everybody. The broad base, the value of the entire economy going up and down. It's not about flight to capital or things like that. We now have capital generation at the source everywhere where it's needed. And there will be regional differences, but that's what we want. Okay? So that's how it would work at a federal level to go to an equity model. That's how it would work at a corporate banking level. What about a personal level? This is a bit trickier, and I haven't thought it all the way through. How do you get personal credit that isn't time-based? I mean, after all, if we are living in a world that has potential for deflation and we want to tolerate deflation, we want to make sure that we live in a world where the time value of money can break and it doesn't break the whole system. How do we have personal credit? What would personal equity look like? Well, what I would say is that any good financial planning starts with insurance. That's just the bottom line, making sure that all of the basics are taken care of, no matter what happens. And insurance starts with the net potential of any given person. I mean, what are you potentially worth in your lifetime? That determines how much insurance you should have, what your potential income is. So financial planners already have at the heart of it the tool for understanding personal equity. If you have a relationship with a financial planner, they have an incentive to maximize your potential, to help you develop the right skills, find the right jobs, or whatever. And for a little share of your income, they would have a financial incentive in making sure that you're always at your best. Now, this gets a little Orwellian. I mean, you're taking basically a tax being paid to somebody you choose as your personal equity stake. And how would you transfer it? How would you make it work? But this is how a personal equity might work. Having somebody who is a professional that has a whole bunch of other resources that can help you maximize your potential one way or the other. And winds up judging you based on what that potential they see is. Okay? But that's how you would be able to get equity, which would enable you to buy a home, a car, all of those various things that you might need. Now, again, that's not particularly well thought out, but we can move from a debt-based system to something more based on equity. Norway, the fund, is really just the start. The point is that if you want to look at money as a genuine store of value, there has to be an underlying value associated with it. A system based on equity can be devised. The markets that we have, a small tax on them can fund the dividend payment that goes out for all of this. It's not so much that we have outgrown a credit-based definition of money. It's perhaps that we have grown into an equity-based definition of money. We can think of it that way in positive terms. Originally, it was simple precious metals. We outgrew that, but we grew into a need for credit, and now we have grown into a need for equity, building actual value as the basis for all money and for all things in the economy. Now, how exactly it would go up and down, there are still some political decisions to be made within this system, but it is largely market based. And rather than a small number of people in a bond market who are able to be the big players and influence things, it would be broader based. It would be everybody. And if we can get to a good definition of personal equity, it encourages the development of skills and helps drive the ambition of everybody. Once again, economics is really all about that. It's not about the Norwegian kroner, is it? It's about people, their skills, their ability to produce. Having a system based on equity would provide the stable value and the stable system that is more resilient but has a place where people can park money and know that they're going to maintain their value no matter what as the basis, the bedrock of everything. That ability to plan for the future only encourages long-term thinking, the development of skills, all of the things that people need. And I'll talk about stability next, but it really starts with equity. We've outgrown debt, we have grown into equity. It's time to consider an equity-based currency and system for everything. Thank you.